Hello and welcome to Integrated Capital Management's Q3 2025 Market Insights webcast. My name is Pete Seiler. I'm a part of our business development team here at iCM, and I'll be joined in a moment by iCM's Director of Investments, Ryan Lehman. But before we jump into our material for today, I'd like to take a moment on just a few housekeeping items. First, this webcast is being recorded. Therefore, all participants are on mute. The replay of this webcast will be sent as a follow-up to all registrants, as well as being posted on our YouTube channel, along with other great content, such as our weekly Markets in a Minute and our monthly Mic'd Up with ICM. If you have any questions during this webcast, please submit them through the Q&A option on your user dashboard, and we'll address those questions as well as the questions that were submitted to us in advance of this webcast at the conclusion of Ryan's prepared remarks. If you should have additional questions for our team, please don't hesitate to reach out to us at info@icm-invest.com, and a member of our team will be in contact with you. Without any further delay, I want to welcome Ryan Lehman. Ryan, the floor is yours.
Yeah, thanks, Pete. So we've got a lot to talk about this quarter because it's definitely been an interesting last 3 months. So why don't we go ahead and jump right into things? So we're going to start off with a few economic data points before talking about fixed income and then getting into equity markets. So just first off, with a look at Q1 GDP, the headline number was clearly a little more disappointing than expected. So we had an annualized quarter-over-quarter change of negative 0.2%. But I don't think this really tells the entire story of kind of what happened in Q1. So what I wanted to do here is just unpack that number a little bit and get into what implications this has for the economy. So big story here was that demand was pulled pretty significantly forward, and this was largely the result of companies trying to get ahead of looming tariffs. So this was reflected in really two components of the quarterly GDP number. So you saw the change in private inventories, and then you also saw a pretty large drag from net imports. Now, on the personal consumption front, results here were okay, but not great, which could be indicating that consumers are still a little hesitant to spend given that potential uncertainty that's currently being driven by tariffs rather than trying to kind of get ahead of things like we saw on the business side. That said, though, you don't typically see a ton of volatility here because despite consumption typically accounting for about 2/3 of GDP, it usually isn't going to be that big driver of economic disruption because most households, if you think about our budgets, they're going to be relatively fixed. Well, we might not make those big purchases. We still need to pay for heat, food, basic necessities, regardless of kind of what's going on in the economy. So the typical driver of a large decline is going to be business investment, which we just haven't seen yet. So that's what we'll really want to be keeping an eye on here in the next coming quarters as some of this stuff washes out. So I mentioned tariffs, so kind of keeping along on that theme, the fear of many, including the Fed, is that tariffs are going to have this one-time or potential multi-month impact on inflation as consumers really have to start absorbing these new price increases. However, what we see in the data is that companies aren't really passing through these costs just yet. In fact, we've seen a pretty meaningful decline in month-over-month inflation since January. Although we did get a new GDP reading this morning, we saw a little marginal uptick in June in that data, but still a little bit below what expectations were. So what this kind of implies is that companies are likely waiting to kind of determine the permanent state of trade deals before actually passing those price increases directly along to the consumer. And with the goalposts being moved constantly now back to August 1st at this point, there's still a good amount of uncertainty that still does exist out there. Now, the question this does bring up, though, is that if firms aren't passing price increases along to the consumer, then they must be absorbing the increases themselves. So what's the potential impact on earnings that we might see over the coming quarters? And this is something that that's more of a kind of down the road impact, so say Q3 or Q4, than something that we're likely to see in the coming quarters earnings season. So definitely something we want to keep an eye on. So if we switch gears, take a look at labor markets. We've seen a bit of a softening here, but all in all, we do continue to still be pretty resilient. So companies have pulled back a little bit on hiring. That's indicated by the non-farm payrolls data, but we don't necessarily see an uptick in layoffs. The quits rate still remains pretty robust, and there does continue to be one or more available jobs available for every unemployed worker, according to the JOLTS data. So at the moment, this appears to be just kind of this slight passing storm rather than anything that should really start to worry economists. So hiring's down a bit, but still healthy. And it's our guess that as the trade deals start to get finalized here, this cloud of uncertainty should lift, which should allow businesses to resume their normal hiring. All this assuming that tariffs don't have that unintended impact of leading us to a recession later this year or early next year. So just to kind of tie all this together, what does it mean for interest rates and the Fed as we look ahead here? Well, the Fed is in a little bit of a difficult spot at the moment. So we've got inflation kind of returning to their 2% target. GDP growth looks relatively good despite what we saw in Q1, and we already talked about some of the anomalies there. And then the labor market is softening a little bit, but still pretty strong. So in reality, many would likely expect them to be cutting at this point, given the still relatively high level of rates. In fact, if we look back to September of last year, the market expected rates to be cut by as much as 6 times before the end of this year. In reality, though, we all know this, we've seen 0 cuts so far in 2025. And if we look at what markets are expecting today, we have just shy of 2 cuts by the end of the year. So big question is kind of what's happened to kind of change those expectations so dramatically. And the answer is tariffs. So tariffs happens, which really have not just introduced uncertainty, but what they've also introduced is the all too real risk of stagflation. And this becomes a really difficult environment for the Fed because what they would have to do in that type of environment is inevitably choose which mandate they want to favor. Do they want to focus on slowing growth of the labor markets, or do they want to focus on rising inflation? Now, if we think about where we are today, there's no real sign of this at the moment, but it's a driving factor behind why rate cuts have been dialed back so meaningfully over the last 9 months or so. And Chairman Powell even himself mentioned that if tariffs weren't in the mix at this point, there is a very good chance they would have lowered rates already. So that's the economy. So we want to shift gears here and talk about fixed income a bit. So just looking at what happened on the quarter and for the year. So we got the majority of fixed income assets getting off to a pretty good start so far in 2025. We've got the Bloomberg Aggregate Bond Index higher by just over 4% on a year-to-date basis. But if we look at what's really done well, it's really been risk assets that took the lead in Q2. So high-yield bonds gained 3.5%. They're now higher by 4.57% for the year. And this has really been driven by a combination of coupon clipping. They still have those attractive absolute yields. And then spreads narrowing pretty meaningfully post that Liberation Day spike. But the big winner has really been emerging markets local debt. So here you're going to see returns of 12.26% for the year and 7.62% just on the quarter alone. And we're going to discuss this a little bit in detail a little bit later on in a few slides. But big driver of these outsized returns was really weakness in the dollar, and the dollar's fallen by as much as 12% from its January highs. Now, on the flip side of all that, on the opposite end of the spectrum, we've got municipal bonds. So they're actually slightly down on the year. There are a number of factors potentially contributing to this. So it's going to include concerns over the potential loss of their tax-exempt status, an increase in supply in terms of what we've seen over the last 2 years versus prior years. And then lastly, it could just be simply investors selling off those assets to pay their tax bills back in April. But at the end of the day, this has left munis lower by 35 basis points on the year. And we'll dive a little bit deeper into this asset class in a slide or two. So diving into fixed income markets, I want to start with the current shape of the yield curve, which has seen a pretty good deal of normalization in just the last year or so. So if we think back to 2023, we had the slope between the 2 and the 10-year Treasury trading near 100 basis points inverted, implying that you actually got about 1% more yield from owning short-term bonds versus those bonds that are down at the longer end of the a curve. So great time to own short-term bonds, given that the slope between the 2 and the 10-year typically trades at around 90 basis points upward sloping. So this inversion, it's been slowly unwinding over the last year and a half or so. Main reason being that short-term inflation expectations have come down pretty meaningfully, and the Fed did start cutting rates last year, although they haven't really done anything so far this year. So what implications does this have for investors? Well, I think it implies that today isn't really a bad time to start thinking about adding some duration back to your portfolio, especially for those investors who are heavily overweight the short end of the curve or have just been simply sitting in cash for the last couple of years. So as that curve does continue to normalize, get back to that kind of 90 basis points upward slope, we're at about 50 today. Even though we still have a little ways to go, not only what's happening today is you're picking up a positive carry at the longer end of the curve, but it also provides some room for rates to decline and act as a ballast to your portfolio in periods of market stress. So one of the position changes that we've made over just the last couple months has been adding a little bit of longer dated treasuries exposure to our TISEL opportunity strategies. And we could potentially see that increasing if this kind of normalization trend does continue. So to talk about munis, one of the fixed income market's worst performing assets this year, and there are really a number of fundamental and technical reasons for the underperformance. So if we start with some of the fundamental reasons, so there are those fears that currently exist around municipal bonds losing their tax exempt status. This is likely unfounded, but still a remote possibility there. So that's clearly weighing on investors. Then in addition, we also have concerns around the negative impact that some of those provisions in the Big Beautiful Bill might have on local and state hospitals with those potential cutbacks in Medicaid benefits. Now, if we think about kind of what's going on the technical side, which is what you're going to see in the top pane of this slide, you're going to see that big clear jump up in supply. And most notably, if we continue on our current run rate, 2025 looks to have the highest issuance of new municipal debt in really the last 20 years. So you kind of combine all these things together, and it's clearly posed some pretty significant headwinds for the asset class, despite taxable bonds doing quite well. Now, if we think about these bonds from a valuation standpoint, this is starting to make munis look somewhat attractive, in particular if we look at them versus treasuries. So as of the end of the quarter, we had muni yields trading pretty close to on par with treasuries. Long-term average there is going to be closer to 90% if we remove some of those outlier environments. And if we see this push further, what it is going to do is it's going to make an even stronger case for munis to be utilized within taxable investors' portfolios, and then could potentially even start to make them look attractive as a potential crossover trade for tax-exempt investors, which we have experienced at multiple points over the last number of years. So definitely something to keep an eye on. Now, moving on to high yield bonds. So like I mentioned earlier, strong performer this year. Story here, though, is caution as we look ahead. So spreads did gap out at least momentarily around that Liberation Day announcement, but they did revert pretty quickly as equity markets rallied and investors kind of re-embraced risk. And I think the one key thing to consider here is exactly what pressure tariffs are going to have on profits. So will bankruptcies rise due to tariffs? Will business sentiment shift lower, causing kind of those marginal companies begin to fail? It is possible, and if it does occur, it is likely those high yield issuers that are likely to be disproportionately impacted. So that's why currently our view that at current spread levels, high yield bonds are a bit of a risky proposition here, despite offering what might appear to be a pretty attractive absolute yield. And then lastly, just to touch on emerging markets local bonds. So they've really been a standout performer this year. So you've got gains of just about 12% on a year-to-date basis. And those returns have really come from a pretty diverse set of performance drivers. So if you look at price and income returns, you're going to see gains of just over 5%, which is going to be a tad better than U.S. investment grade bonds. But if you add in the currency impact, that's really where we find the greatest contributor to excess returns. So over just the last 6 months, the dollar's depreciated by about 6.5% versus the basket of EM currencies. And since we're US-based investors and these bonds are denominated in local currencies, that change is going to go directly to bottom line performance for the asset class. Now, the big question is, though, we've seen really good performance this year. Can this continue? And we would say yes. There is a pretty good likelihood that we could see this kind of trend continue with EM bonds outperforming U.S. investment grades. So if you look at the left pane of this slide, we have a potential annualized return over the next 9 years of just about 9% annualized. Now, a good part of that comes from the yield on these securities. That's still around 7%. But we also see a pretty large contribution expected to come from the currency appreciation versus the dollar. So even with the run that we've seen over the last 6 months, EM currencies, they do continue to look meaningfully undervalued versus the dollar. And even with just simple reversion to the mean, they could legitimately contribute about 2% per year for the next 6 years and possibly more if you kind of overshoot that. So as a result, outside of core fixed income, this asset class continues to be a really high conviction idea for us across nearly all the portfolios that we manage for our clients. So moving on to equities. Equity markets in general saw a pretty strong rebound in Q2 after kind of a shaky first quarter. So we did shake off that near technical bear market that occurred following Liberation Day. On the quarter, U.S. large growth stocks, they were a top performer. They were up nearly 18%. Drivers here, investors started to re-embrace risk as kind of that uncertainty and risk of tariffs. The initial shock kind of wore off. And then we also saw many of those large cap growth names post better than expected earnings results in Q1. We just started Q2 earnings season really today for the most part. So we'll see if that trend continues. Outside of the U.S., however, it's really been non-U.S. stocks that have led the way after trailing for much of the last number of years. So we have non-U.S. developed stocks and EM stocks all outperforming the S&P 500 in both local and U.S. dollar terms. And the big story here, and what's most important to everyone on this call, are those U.S. dollar returns, which, similar to EMD, saw a really significant tailwind as concerns over the United States' fiscal situation weighed pretty heavily on the dollar. Now, at the bottom of the pack, you're going to find commodities and small cap stocks. So small caps, although putting up some pretty strong results on the quarter, they still have a bit of work to do to erase some of those losses from earlier in the year. And then commodities, although they are positive on a year-to-date basis, they did struggle in Q2. And a lot of that's just due to volatility in energy markets, which was really impacted by that conflict that we saw in the Middle East. So diving a little bit deeper into global equity performance this year, I just wanted to highlight a key trend that's developed and has continued through much of 2025. And that's been the dominance of non-US markets over the US. So in the first half of 2025 alone, we have emerging market stocks up over 15%. We've got non-US developed stocks up nearly 19.5%, and then we see the S&P gaining just over 6%. And the reason for this is pretty straightforward. So non-US markets are seeing improving fundamentals. They've got the potential to benefit from stimulative monetary and fiscal policy. They trade at still relatively attractive valuations, despite the outperformance that we've seen so far this year. And we've also seen that meaningful sell-off in the dollar that I've mentioned a number of times already. And all of that we're going to talk about in pretty great detail here in the coming slides. So I want to start our discussion on the case for non-US stocks by talking about valuation. So here we have valuation data going back about 30 years. So we're using price to trend line earnings because what that does, it allows us to look at EM equities all the way back to 1997. And essentially, price to trend earnings is really similar to a CAPE ratio in that it just helps you smooth out or normalize the index's earnings stream instead of just simply looking at a trailing 12-month or a forward PE. And what you're going to see is that despite this year's outperformance, non-US stocks still trade at very attractive discounts to their US peers. If we look at the simple simple discount, you're going to see that non-US value stocks, they trade at a near 65% discount. And then EM value stocks still at an 80 or so percent discount as we stand today. These are essentially their cheapest levels on record. So even if you see just a kind of a bit of normalization or reversion to the mean here, it could add meaningfully to relative returns versus US stocks as we look out over the next number of years. Now, from a fiscal standpoint, we've heard a good deal about this lately, which speaks to one of the reasons the dollar has sold off so meaningfully in 2025. But it also really speaks to the ability of non-US economies to implement additional spending and pursue stimulative monetary policy. And here, just for easy use, we're simply comparing the US fiscal situation with Germany. So the US, as of the most recent data point, we were running a budget deficit of just about 6%, and we were operating at a debt to GDP ratio that's roughly 120%. So if we look at Germany, on the other hand, they currently have a budget deficit of less than 3%, and then a debt to GDP ratio of just over 60%, both which are roughly about half of what we're experiencing here at home. Now, the problem with this mismatch is that these levels for the US are relatively unsustainable, and at this point it's nearly impossible for us to grow our way out of this situation. So this makes it really difficult for us to kind of continue to artificially prop up growth through things like deficit spending or monetary stimulus. And this leaves really the only logical solution as some sort of austerity, whether it's a cutback in spending, higher taxes, something like that. But the current fiscal situation we've gotten ourselves into is definitely unsustainable at these levels. Now, Germany and much of Europe, for that matter, they have been undergoing austerity for much of the last decade or so, which does give them room to expand spending and make large investments in technology, infrastructure, and defense. And this is something that was announced out of Germany earlier this year. And all of this is really a positive both for future economic growth as well as earnings growth for the companies that are based over there. And what this essentially means is that the growth advantage for the US economy, that US exceptionalism for the economy and for US companies, could become compressed over the coming years, which is exactly what we see here in terms of the Bloomberg consensus estimates for both GDP growth as well as corporate earnings growth. So this raises the question of why we would want to continue to own such a relatively large weight to US stocks, which trade at lofty valuations and no longer offer that growth premium they have over much of the last decade. So from an asset allocator standpoint, what we would rather do is focus our portfolios on those relatively cheap stocks who have the potential to benefit from supportive monetary and fiscal policy, as well as a rebound potentially from this cyclical low that we've seen in earnings. And then kind of the last piece of this equation, we talked about this a bunch already, not necessarily fundamental, but clearly adds to U.S. investor returns and dollar assets. So this is going to be valuations for the U.S. dollar. And really, regardless of what metric you look at, the dollar looks relatively expensive today, despite that sell-off that we've seen so far this year. And here we show valuations through two different lenses. So we've got just a simple price trend valuation. Then we're also looking at something a little more fundamental called purchasing power parity. And what you're going to find is that on both metrics that the dollar is about 20% overvalued, or said differently, non-US currencies are about 20% undervalued. So if we do see some mean reversion here, just back to fair value over the next decade, you have the potential to see an additional 2% or so return on top of the fundamental return that you're going to get from dividend income, earnings growth, and then in addition, any potential reversion in those PE multiples. And then just lastly, in the non-US equity front, may have alluded to this already, but non-US assets are significantly underrepresented in investors' portfolios today. So if we look at a study that Fidelity did earlier this year, they found that the average advisor allocates just 20% of their clients' equity portfolios to non-US stocks. If we compare that to what would be considered a truly passive portfolio or truly passive allocation, the MSCI ACWI index has about a 36% allocation to non-US equities, with about 10% being allocated to emerging market stocks. Now, even if we just start to see a small shift in this number, this potentially means trillions of dollars flowing out of US stocks into non-US stocks. And what it also does, it also heightens or increases that demand for non-dollar currencies as you need to sell dollars and buy euros or yen to purchase those non-dollar assets. Now, on the right-hand side of this slide, if we look at fund flow data, it's probably too early to call this a trend. But what we have seen for the first time in quite a while is a disproportionate share now of net ETF flows moving into non-US stock funds. So we've got non-US equities as of last month taking in about 2/3 of net assets, which definitely bodes well for non-US stocks in the near term, and could be just an indication that investor demand is starting to increase for these assets. So just to kind of wrap up here, we'll touch on some non-traditional assets. So if we look at closed-end funds, generally a good quarter with discounts narrowing a bit following that Liberation Day volatility. So this left the average fund trading at a discount of just around 4%. So this is marginally inside the long-term average. That's about 4.7%. That said, we do continue to see a bit of a bifurcation here across different asset classes. So equities slightly inside their long-term average. Taxable bonds continue to appear really expensive, so they're just 1.5% below NAV on average. And then if we look at munis still present a great deal of opportunities here. So the average muni fund, that has come in meaningfully in terms of the discount, but it does still trade at nearly a 6% discount to NAV versus a long-term average that's about 4%. And with munis struggling thus far in 2025, like we talked about earlier, if we were to see interest rates start to decline or the asset class start to get a bit of a bid from investors, we could see those discounts narrow pretty quickly, which would add meaningfully to returns for closed-end fund investors. And just to kind of tie everything together here, go through our asset class forecasts and our strategy positioning. So if we start with our long-term return expectations, the order here, even with that kind of big performance swing we've seen so far year to date, order hasn't changed, but we have seen a reduction in return expectations given those strong results last quarter. So most notably within the US, we've got US large cap stocks at just 2.5% annually for the next 10 years, while at 0.6% annually, large cap growth stocks are actually expected to produce a negative real return over the next decade. And then within the US, quality value and small cap, they kind of look like the proverbial best houses in that so-called bad neighborhood. And as we'll see momentarily, we do continue to maintain overweights to value and quality in our strategies. However, though, thinking about small caps with economic uncertainty still kind of high, small cap valuations, we feel like they need to come in a little bit more, or that gap needs to widen a little bit more before it really starts to make sense to increase our tactical allocation there. And then we have kind of our standout non-US equities on the far right. So we've got non-US developed stocks at just over 9%, EM at 19%. And this comes despite that strong outperformance we've seen so far this year. And the big driver of this differential is going to be exactly what we talked about on those previous slides, primarily valuations and currencies, both of which favor non-US stocks as we look out over the long term. And then next, just an interesting chart that we've shown a few times now. So what this does is it measures what we refer to as diversification alpha. So this is essentially the potential benefit that owning a diversified portfolio could create for investors versus owning just a simple 60-40 portfolio. And just to be concise and for the sake of time here, I'm not going to get into the weeds on how this is constructed, but if you do have questions, feel free to reach out to me or a member of our advisor services team, and we're happy to dive as deep as you'd like. But the big takeaway of this slide is that given the current low potential returns for U.S. stocks, from our viewpoint, it's essentially one of the most opportune times in about 20 years to start consider owning assets outside of just U.S. large caps. And at least in the short term, investors have clearly benefited from adopting this type of strategy. And then finally, just to pull everything together, all this is going to directly relate to our strategy positioning. So we've got a pretty sizable underweight to U.S. stocks, and within the U.S., the most meaningful tactical positions are going to be an overweight to U.S. value, with that value positioning being largely focused on attractively valued, deeper value and higher quality names. Outside of the U.S., we have meaningful overweights to both international and emerging markets, as well as uh, out of benchmark positioning in commodities. This is relatively unchanged since last quarter. And then on the fixed income side of the equation, small underweight to duration and then neutral sector exposure, and pretty consistent with what we discussed earlier. No exposure to high yield, where spreads are still very tight, despite gapping out a bit in April. And then lastly, we have that out of benchmark position in EM local bonds. And this is an asset, like we talked about earlier, that has the potential to benefit from that positive carry over US bonds, and then potentially continued headwinds for the US dollar. So where might we see changes? I'd say there's a couple areas. So one is on the fixed income side of the portfolio. So we are getting close to where it might make sense to move a little bit more of our core fixed income exposure out to the belly of the curve, or even at the longer end, with the 2 to 10-year slope sitting around 50 basis points. We're also keeping an eye on credit spreads for both investment grade and high yield bonds, but this is still really early here. And then on the equity side of the portfolio, we're really just trying to be contrarian and think about how we might position for potential upcoming market uncertainty should tariffs continue to weigh on investors. So this would lead us to look at, say, like cyclically sensitive assets like higher beta small caps and or REITs. But like the kind of the credit side on fixed income, we think it's still a little bit early here given the level of uncertainty, and then the potential volatility that's baked into markets, largely as a result of uncertainty around tariffs. So with that, that concludes all of my prepared remarks for today. Pete, do we want to check the Q&A to see if we had any questions come in?
Absolutely. Thanks, Ryan. Just as a reminder to everyone, if you do have a question, please do use the Q&A option on your user dashboard. We've had 2 submitted so far, so Ryan, we'll jump right in with the first one. What are your expectations for Fed rate policy going forward?
It's a good question, because we did talk about market expectations, but not necessarily our view back in the fixed income section. I would say at this point, given that we're already in July and a cut is pretty much off the table for this month's meeting, the market and the Fed are probably pretty close to being correct for 2025, with an expectation of, say, 1 to 2 cuts. But I think 2026 is kind of where it gets a little bit less clear. So right now, we look at where market expectations are. Total expectations for year end 2026 are 4.5 cuts from here. So what that would imply is 2 cuts in 2025, and then another 2.5 cuts into next year. And I guess the question is this possible? I'd say maybe, if things fall into place perfectly, but there are a bunch of factors out there to consider. So first, if we think about tariffs, if they cause some sort of sustained inflation rather than just kind of this one-time uptick, the Fed would likely be on hold for a little bit longer than expected. But then if you kind of think about the opposite end of the spectrum, if we do hit a patch of economic weakness, we could easily see many more cuts than 2.5 next year. And then also throw into the mix the uncertainty around what will occur when Chairman Powell is replaced next year. So I guess kind of the long story short is that for 2025, given the amount of time left in the year, we don't really see too much deviation from current expectations. Maybe we get only 1 versus 2. But next year, still very uncertain, because we have a lot of variables that are pretty hard to predict. So the most likely scenario for 2026 is that it's not going to be 2.5 cuts. It's either going to be something less, or possibly something significantly more, which, just thinking about how to manage a fixed income portfolio through that, in either case, it wouldn't necessarily hurt bond investors. In fact, if we get kind of that latter scenario where rates come down significantly, it's likely going to result in pretty attractive gains for those holdings in treasuries.
Okay, Ryan. Second question that's come in. What is your outlook for U.S. equities?
Yeah, no, another one because I know today we spent a lot of time on why non-U.S. stocks look attractive, but we didn't really touch on U.S. stocks too much until at the very end. And I would say the story here hasn't changed too much. So U.S. stocks are still pretty pricey, regardless of what valuation metric you look at. But this is still going to be generally skewed by large growth names, and in particular, those highly concentrated Mag 7 names that make up a very disproportionate amount of the market these days. So, what we'd recommend to those constructing a U.S. equity portfolio is simply avoid the concentration risk of the large growth side of the market and focus more on those attractively valued areas. So, value stocks still look historically cheap versus growth, even though they've done relatively well this year. And then quality stocks, they're still trading pretty close to fair value. And if we think about the characteristics of quality stocks, what they typically do is they do provide a nice degree of downside protection during periods of economic uncertainty. So if we do get ourselves into trouble later this year or at some point next year, they're likely to do well. And it's also not a bad time just to start thinking about small caps. So we've had years of underperformance that have really started to compress valuations there, especially compared to their large cap counterparts. But the risk here, and I mentioned this earlier, is if we do hit a proverbial rough patch, those valuations could get even cheaper. So I guess the moral of the story here is you don't need to necessarily abandon U.S. stocks because there are some pockets of opportunity that look pretty attractive. And U.S. stocks obviously still do account for a disproportionate amount of the global market cap. But at a high level, just completely looking top down, we'd recommend looking outside of the U.S. for those best opportunities, especially if you're trying to position your portfolio for the long term, because these assets, non-U.S. equities, emerging markets equities, really have the potential to benefit from a whole host of tailwinds that we talked about in great detail throughout today's presentation.
Thanks, Ryan. That's the last question that was submitted by our audience here. So this will conclude our quarterly market insights webcast today. As a reminder, the replay of this webcast will be available on our YouTube channel. We encourage you to subscribe to our channel to receive notifications of new video content, including Markets in a Minute and Mic'd Up with iCM. I also want to encourage everyone to check out our Advisor Content Center as an outlet for great strategy-specific content. Thank you for joining us today. We hope you enjoy the rest of your summer.